Restaurant Brands International has one story the market has priced for years. Tim Hortons is Canada's coffee institution, not just a brand, but a cultural fixture. That story rests on a hidden assumption: foreign competition tried and failed. Dunkin entered Canada once before, and it did not stick. The market concluded the Canadian coffee market was structurally resistant to foreign entry. That conclusion has been the floor under QSR's Canadian franchise valuation for a long time. This week, that floor cracked, not because Dunkin succeeded, but because it returned. Inspire Brands, which owns Dunkin, announced plans to eventually open 300 Canadian stores. That number alone is not the point. The point is that a well-capitalized U.S. operator with a rebuilt operational model looked at Canada and chose to try again. The buried assumption in the bull's standing read is that Dunkin's prior exit was structural, that something about Canadian consumer preferences made entry unviable. If Inspire Brands concluded the failure was execution, not structure, then the entire floor changes. Retail analyst Bruce Winder noted explicitly that the strong public reaction online to Dunkin's announcement suggests pent-up consumer appetite for more competition in the Canadian coffee sector. Social media criticism of Tim Hortons around service quality, order accuracy, and cleanliness has been building. That is not a price move in isolation. It is a demand signal for the category. The 300-store ambition does not need to succeed fully to damage QSR. If Dunkin captures 5% of Canadian coffee visits over 3 years, Tim Hortons' same-store sales trajectory shifts, and with it the royalty revenue stream that underpins QSR's franchise model. The question the market has not yet fully priced is whether Dunkin's return changes the category structure, or whether Tim Hortons' brand loyalty absorbs the shock. That question cannot be answered yet, but the fact that it is being asked for the first time in years is itself a regime change for how this stock should be evaluated. Tim Hortons did not wait for Dunkin to open a single Canadian location. The company announced it will pour $400 million into store renovations and open 80 new Canadian locations this year. Winder told Retail Insider that Tim Hortons had been planning these renovations before the Dunkin announcement, but he also acknowledged that the public reaction to Dunkin's return likely accelerated the response strategy. That acceleration is where the allocation question lives. A renovation and expansion program of this scale serves two functions at once. It modernizes the physical estate, which is necessary regardless of competition, but it also signals to franchisees and to the market that management takes the threat seriously. Here is what that matters for a QSR holder. Restaurant Brands International operates on a franchise model. The company receives royalty income as a percentage of franchisee sales. The $400 million is not QSR's capital directly, it flows primarily through franchisees. But accelerated CapEx at the franchise level puts pressure on franchisee economics. If renovation costs compress franchisee margins, operators may push back on other initiatives, delay adoption of new menu formats, or reduce discretionary reinvestment. That is the second-order variable that the surface coverage has not yet resolved. The bullish read assumes the CapEx strengthens brand equity fast enough to offset competitive pressure on same-store sales. The bearish read assumes the CapEx arrives too late, and Dunkin's physical presence will already have established alternative consumer habit loops before renovations are complete. The honest answer is that the timing of renovation completion versus Dunkin's actual store opening velocity will be the observable checkpoint. Dunkin has not announced a specific opening timeline for its first 300 Canadian stores. That ambiguity is asymmetric. It allows management to delay without penalty, while Tim Hortons bears renovation costs now. Winder noted Tim Hortons has learned to balance menu innovation with operational efficiency. Whether that balance holds under competitive acceleration and CapEx pressure simultaneously is the unresolved question heading into QSR's next earnings cycle.
There is a third force operating on this stock that most coverage frames as a public relations story. It is not. It is a franchise labor structure story, and it carries regulatory risk. Tim Hortons announced it will hire 10,000 local Canadian workers and said lobbying for expanded access to the temporary foreign worker program is no longer necessary. The announcement came alongside the Dunkin and renovation news, a single week of simultaneous catalysts. The TWFP reversal has a concrete scale. Roughly 4,000 of Tim Hortons' 110,000 Canadian employees currently come through that program. Those workers have tied immigration status to employment. Migrant worker advocates, including the Migrant Workers Alliance for Change, have publicly stated that a rapid replacement of TWFP workers creates deportation exposure for current employees, whose status is employment conditional. That is not a social commentary. It is a franchise liability variable. If regulatory action or litigation follows the transition, franchisees, who manage local hiring, absorb the operational and legal cost. What the articles also surface is a more fundamental tension in Tim Hortons' public positioning. The company has historically been one of Canada's leading lobbyists against minimum wage increases, according to advocacy groups quoted in the Broadview coverage. The new local hiring campaign is being framed as support for Canadian youth, but the same brand is credibly linked to wage suppression advocacy. That contradiction is not invisible to Canadian consumers, at a moment when affordability is a dominant political theme under Prime Minister Carney's government. The brand risk here is not that one campaign fails, it is that the contradiction between wage suppression lobbying and the Hiring Canada narrative becomes a durable perception liability. Winder's observation that Tim Hortons is reinforcing its Canadian identity amid foreign ownership perceptions cuts both ways. The brand needs that Canadian identity story to work precisely because Dunkin is entering. If the TWFP narrative corrodes that identity story faster than renovation and hiring can rebuild it, the two strategies arrive at cross purposes. Youth unemployment in Canada hit 14% in April, according to Statistics Canada, figures that analysts described as unusually high outside of a recession. Tim Hortons is publicly linking its hiring campaign to that number. That anchor is the confirmation signal for this analysis. If the 10,000 local hiring target is filled ahead of schedule and franchisee labor complaints remain contained, the brand identity reinforcement holds and the defensive strategy lands. If the TWFP transition generates visible regulatory or labor disputes before Dunkin has opened a single store, the 300-store threat becomes far more potent because the narrative of a weakened Canadian institution will already be running in public. Watch the hiring completion rate against Dunkin's first confirmed Canadian opening. That race is the real forward checkpoint for QSR holders this year. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.